Hi, I'm Jose Armenta, and this is your Federal Employee Benefits. Today we're answering the question, should you use your TSP to pay off your mortgage when you retire? Whether or not you should use your TSP to pay off your mortgage is a common question that federal employees ask. And my answer is often it depends. Because although it may seem like a smart financial move to get rid of what is often a large debt, there are several factors that must be considered before deciding whether it's the right financial move for you. And while everyone's situation is different, there are some significant disadvantages to using your TSP to pay off your mortgage. And for many of you, these disadvantages will outweigh the advantages. So today we're going to cover two factors that must be considered when deciding whether or not to use your TSP to pay off your mortgage. The first and often the most significant factor that should be considered are the tax implications. And the reason is because most federal employees have the majority of their money in the traditional TSP, which is pre-tax, meaning the money has not been taxed and was not taxed when it went into the account. So when you withdraw your money from the traditional TSP, all of the withdrawal is considered taxable income. Now this is important because we have a progressive tax system, which means the more money you earn, the more taxable income you have, the higher the tax rate you're going to pay. And so often what happens is when federal employees pull out a large amount from their TSP, they're bumping themselves up into a higher tax bracket, meaning they're going to pay taxes at a higher rate. And so let's look at an example of how withdrawing a large amount from your TSP can result in a significant tax bill. For example, let's say you want to pay off a mortgage of $250,000 and have gross income of $170,000 a year. You're married filing jointly, so you have a standard deduction of $25,900 and your marginal tax rate is 22%. Before the withdrawal, your taxable income would be $144,100. Now, if you want to pay off a mortgage of $250,000, you would actually have to withdraw more than $250,000 since the TSP is required to withhold 20% for estimated taxes. So to pay off a mortgage of $250,000, you would have to withdraw $312,500. $250,000 to pay off the mortgage plus the $62,500 that the TSP will withhold. But remember, the 20% withheld is only an estimate. In our example, your tax liability would actually be closer to $109,200. So in this example, your tax liability went from $23,400 to $109,200. But hold on, how are you going to pay these taxes? Most people don't have over $100,000 sitting on the side for taxes. So most people will have to withdraw enough money to not only pay the mortgage of $250,000, but also to pay the taxes of $109,200. So in our example, you're actually going to have to withdraw $359,200. The $250,000 for the mortgage plus the $109,200 for taxes. This example shows how important it is to consider taxes when deciding whether to use your TSP to pay off your mortgage. And by not considering taxes, you can be making a critical mistake. Now, the second factor you should consider is the opportunity cost of taking money out of your TSP. Now, when thinking about being debt-free, it's helpful to categorize debt as good debt and bad debt. Okay, your mortgage likely falls into the good debt category because it's likely a fixed interest rate and likely a historically low interest rate. And when the interest rate on your mortgage is lower than the expected rate of return of your TSP, you're going to be better off keeping your money invested in the TSP. Now let's look at an example of opportunity costs. And we'll use the numbers from the last example. So let's say you kept the $359,200 invested in the TSP for 10 more years, and it had an annual growth rate of 8% a year. That $359,200 would grow to $775,485. Okay, that's an additional $416,285. Now compare that to the money you would have saved from paying off your mortgage. Okay, let's say you paid off a 30-year mortgage with 10 years remaining and a 4% fixed rate. You would have saved a whopping $54,400 in interest payments. Okay, that's a opportunity cost. When we compare what you saved in interest payments to what you lost in growth opportunity, that's an opportunity cost of $361,885. That's a huge cost to pay in addition to the tax liability you would have from the withdrawal. Although paying off your mortgage can feel like a huge financial accomplishment, because of the tax implications and the opportunity costs, it is rarely the smart financial choice. If you found this video useful, make sure to subscribe. And if there are any topics you want me to cover in the future, let me know in the comments below. Until next time, I'm Jose Armenta. Take care.